to talk about in the world, and in the world of obviously the geopolitics and Russia, Ukraine. And as a guy that lived in Russia and was an emerging markets guy for a major part of my career, these are obviously devastating, scary, and incredibly unfortunate times. And then the connectivity between different asset classes. And so I'll stay out of politics, I guess, but I'll just say that as a man that spent a lot of time in that part of the world, it's very sad. And the dynamics around the commodity cycles, but the interconnectivity of really global macro for markets is wild. And think of the impact on the euro, think of the impact on European government bond yields and spreads, and credit dynamics that we dealt about, in Europe a decade ago. Europe was about to blow, right? And so there's different things at work here. Obviously, the commodity long tail cycle that's happening, and really, right, there's a whole generation of investors that probably appropriately hadn't invested in commodities and don't really understand. This isn't to sound also arrogant. It's just saying that the dynamics here are a function of, first of all, just cycles that are long. And when I was living in Russia, but came back to the U.S. to open up, the U.S. arm of a Russian investment bank, and we were very active in commodities. 2001, 2002 is when people first started looking at some of these things. Obviously, oil prices were, I think, at their lows in the crisis of after Russia blew up, .com, you name it, long-term capital, oil got down to, $9 a barrel. Now, some of this was technical and weird dynamics with contracts and whatnot on the exchanges, but oil was $21 in the lows of COVID. And here we are talking about, anyone's been out buying gas this weekend knows that, most likely, we're going to be well north of $5 a gallon in the U.S. soon. And this is, a lot of people think, oh, well, winter's ending. It's a beautiful day here in New York City. But 25% of U.S. oil demand is the American driver. And we're just getting into driving season. And my guess is, based upon reopening trends that are more social dynamics, leaving aside the economic ones, and hopefully, that part of the spectrum that we've had to deal with for the last couple of years continues to be trending in the right direction. But oil demand's, I think, going to go higher. So anyway, there's a lot to think about with regards to currencies and interest rates. The Fed's meeting this month, and we're all assured of 25 bips. The question is really what's going to be going on in successive rate hikes. Can they do what really I think we all know they need to do? Because there's runaway inflation, and so back to Eastern Europe, this is coming at a time when the Fed didn't need these additional pressures, and you've got them, and so but it does feel a little bit like Groundhog's Day with gold, with uranium. With some of these other, as I say, real kind of macro trades that I think still have some life.